Your notes prompted me to look at this. Still, S&P 500 stocks are yielding more than 10-year treasuries, of course, because inflation-adjusted yields there are even lower. But doesn't it concern you a little bit that we've gotten to this level?
Well, look, I mean, I think that there are risks in the market, and the fact that we're 20% above where we were before the pandemic does have a lot of our clients wanting to pause here. But I think we see some positive signs. One is what you just described in the fancy term, right, is the equity risk premium, and that still looks attractive compared to the alternatives like treasuries. And second, don't forget the monster earnings season that we're having. We're expecting S&P earnings to increase by 40% this year. And finally, many people still don't believe in the reflation that we're going to get out of this pandemic, and we do.
What is the one, Mark, so what kind of inflation expectations are you actually seeing? Is the market mispricing what we'll see?
Well, we think that in our central case that we're actually going to have peak inflation around now, and it's going to start to fall back again. But, you know, even if you get a little more inflation pressure, I think that plays into our theme that you want to stay in the stocks, but more the stocks that are positioned for reflation, such as energy, financials, and materials.
You remain positive on the outlook for global equities, but if inflation surprises and we have a lot more volatility, you know, how bumpy will it be ahead, Mark?
You know, how bumpy is always difficult to predict, but I think if you think about a path towards that higher inflation and those fears persisting, you know, this is still an environment where we have seen equities remain strong. Particularly, I think the momentum over the past 6 months is going to lead a lot of the quant funds. Some of the things we're seeing in our quant work is to continue that pressure towards the value, towards the sectors away from kind of the mega cap tech. So I think under the indexes, that rotation would continue even if the volatility picked up.
Inside of that rotation, Mark, what still looks cheap?
Well, yes, cheap is a relative word, but I think that this energy trade, the materials, the smaller caps all trade at much better valuations. I mean, we think that S&P 500 is at about 17.5 times forward 2022 earnings, whereas big cap tech is more like in the 27 times. So while that's not in and of itself, without looking at bond yields and reflation, not necessarily cheap, I think the valuation disparity means that a lot of people need to rotate because they just have too much tech still.